Okay, good day, everybody, and welcome. My name is Jim Kenney, and I'm with OptionProfessor.com. I provide the content for OptionProfessor.com, and this is the weekly update for August 3, 2018. By way of introduction, I'm a graduate of Boston College, and I've been in the investment business for well over 30 years. And I have familiarity with all different types of investments. So I think I'm qualified to give you some different views, and that's what I'm going to do here today, give you my opinions. Just as a disclosure, don't forget, past performance is not necessarily indicative of future results, and there is risk of loss in short-term trading and option trading. So do consult your broker and your advisor, and of course your own good common sense on what is suitable for you and what is not. I'm not going to be recommending anything to anybody who I've never met. So obviously this is my opinion, and that's where we go. All right. Let's turn to what we normally do, and a lot of news here this week. Last week was big, with that GDP number blowing above 4%. But today, the unemployment report came out, and it was a little lighter than expected. I had seen estimates up to 213,000 jobs. 195 must have been the median, but it came in at 157. So 157,000 jobs added, and employment rate is at 3.9%, which is very close, if not a 20-year low. Two areas that did cut jobs were the banks and government. They both lost or saw jobs go down. And basically, the other situation is they're looking at wages, which was unchanged at 2.7%. With this kind of a tight job market, they're normally looking for 3 to 4% wage growth in this type of environment, but it's just not happening as of yet. You would think with all that tax money they got back, rather than buying all their stock back, they might throw a little bit to the employees, but I guess that's too much wishful thinking for us, right? Okay, so last week we had earnings, quite a bit of good earnings coming out, and the big news this week also is Apple going above the $1 trillion market cap, which is obviously just testimony to when you walk around and you see all the cell phones in everybody's hands. Somebody's got to be making money on it, and certainly Apple's one of them, right? Just to look at the stock, I put it up on the board here because it is such a big news stock. There you go. It's making all-time highs here this week. All-time high is 208. Right now, as I was putting the chart up, it was around 207. So you can see it gapped up. Now, there is a gap now between about 193 or so and about 198. So there's a gap there. I don't know if it'll come down and fill it or not this month, but that volume is also extremely high. And sometimes when you see extremely high volume, it's actually a turning point. Can you see on the graph here? I'm making that shown. In February, we had a big dump down to 150. Look at the volume, huge. That was the end of the dump, right? Then we had another big dump there to 160 back in the April timeframe. Volume jumped up. That was about the end of it. And then, of course, we just had a big volume jump, and we're up around 210. Is 208, 210 going to be it in the short run? It's possible. Keep an eye on it and be a little bit careful about just running in because it's in the newspaper. Okay. All right. Today, let's see. Oh, yeah. Markets look very strong. Obviously, they've been going very good. The month of July saw very strong gains. I think 5% on the Dow, 3.5% on the S&P. So July was a darn good month for the stock market. Having said that, there's always caution flags you have to be aware of, and I'm going to give you a couple right now. First of all, caution flag would be the bullish sentiment. Tom, Dick, Harry, and his brother are all bullish. That's a pretty big sentiment of bullishness. So you have to be careful that everybody who wanted to get in has already gotten in, and finding new buyers may become more difficult in the month of August. Only time will tell. Market participation. NASDAQ just hit highs this month of July, but did you know half of the stocks in the NASDAQ are trading underneath their 200-day average? So again, it's not a across-the-board rally, as you can see, with some of these stocks underneath their 200-day average. Seasonal. When you go into September and October, sometimes it could be rough sledding. So obviously be aware of that. There's been some fairly significant drops in those months. And so be careful of September and October from a seasonal basis. Valuations, obviously the price to earnings ratio is getting a little rich on some companies, which means you're paying quite a bit, and you're doing a little come line betting, which we say here in Vegas, which means you're expecting these earnings to keep going unabated if you're pricing them up like that. And of course, if they ever disappoint, it'll be kind of like what happened to Facebook, I would imagine. Labor shortages sometimes lead to inflation. Tariffs sometimes lead to inflation. That could be a factor looking forward. Trade war, how do we know what's going to happen there? And here's a big one. You got the tax cuts and the stimulus structure coming. And Bloomberg had a chart on this week, which I thought was very interesting. It's tax receipts coming into the government going back to the Eisenhower administration. They had a huge uptrend, right? But every once in a while, it breaks through the uptrend, which means tax receipts drop underneath the trend line. And they're doing that right now. So when that occurs, two things generally occur. Interest rates go up and deficits go up. And I think both of those are fairly likely bets right now if you're looking forward, because the Fed's in a tightening cycle. And if inflation were to come back, because the 30-year bond is only paying 3%, there's no inflation priced into any of this debt. If it ever did rear its ugly head, then you could throw the dot chart off the wall, because they might have to play a serious game of catch up. There's no evidence of that happening right now, but let's not be crazy and not think that that's a risk. Okay, this week, what I'm going to try to do here is I'm going to go over some stocks that are hitting all-time highs. You know some of the names: Apple, Amazon, Google. Okay, all-time highs. But there's other stocks that are hitting an all-time high that you might not be aware of, and I was going to give you some insight on that. In addition to that, I was going to go over companies that raised their dividend by 10% or more and have had reasonable gains for the year. So not only has the stock been going up, but they're raising their dividend, which means you're getting paid more to watch the movie. And that's not too shabby, especially if you're retired and you like to get cash flow on your money. And then finally, I'm going to go over different sectors like tech, healthcare, financials, industrials, international, and materials. And then I'm going to rotate into some other quick information on some other markets as well, such as interest rates in the dollar, oil, gold, silver, and agriculture. So let's get into the first part. Again, the stocks that are hitting all-time highs that you may or may not be aware of. The first one I'm going to put up here, and again, we already know some of the big names: Apple, Amazon, Google. But let's look at one that you might not be watching, and that's O'Reilly Auto Parts. And anybody who's had to fix their car might have heard of this company. But let's take a look at the graph here, and let me show you what's going on here with O'Reilly Auto Parts. Boy, that's a nice uptrend this year, huh? It's gone from 186 to 311. PE ratio is 21, but obviously, people might be holding onto their cars a little bit, or they have extra money because they're working, or their pay might have been increased a little bit. And now what they're doing is they are going out and fixing all their car stuff. And this company, I'm trying to get it in line for you here. There you go. This company obviously gapped up back in May, right? And it went all the way up from 225 to 255, never filled that gap, never looked back. And as you can see, it's made all-time highs here this last month. So that's a company that you might not be aware of. And the volume is not, off the chart as far as it doesn't look like it's gone to a point where it's a blow-off or anything. And again, it does have a pretty steady uptrend. What I like to look at sometimes is the moving averages on these companies. And that gives me an idea of overbought, oversold. Basically, let's take a look at O'Reilly here. You're at 310, and the 200-day average is down at 252. So what I sometimes do is I take the difference between 310 and 252, which is about 62 bucks, and then I divide it by 252, and I get an idea that it's 24% above its 200-day moving average. That's not an area that I'd be interested in entering into a market generally. I'd probably be looking for some kind of a pullback. The other thing is the volume has been drying up a little bit on this rally, and that means that the conviction on it is not quite as great. Can you see the volume on a 50-day basis is 665, and the 200-day basis is 903? So while O'Reilly looks very, very good, and the trend is clearly up, I would be a little careful here, in my opinion, about possibly putting on a new position unless I got some kind of a dip. Maybe the month of August will give a dip, and if it does, obviously this is a company that's been performing quite well. Okay, let's talk about the next one I've got here, which is Ross Stores. A lot of people like to buy their clothes on the cheap, and that's why Ross is in business, right? ROST is the symbol. And they got name brands at discounts. That's their vibe. And a lot of times they're where I live, they're in the same mall with Walmart, so they're getting a pretty good anchor store there. They're also in a mall with Lowe's, so whether you're going to a hardware store or going to get groceries, it's in a good neighborhood. And it's gone from 52 to 89 this year. And again, its PE ratio is 23. These PE ratios, seem to be a bit elevated. That's what I was talking about earlier about the valuations. But, if they're going to keep selling to the consumer, and 2/3 of the economy is economic growth, and the consumer seems to be employed and seems to be having money. And Visa is one that I'm going to talk about in a minute. That made another all-time high, and obviously they got to spend their money some way, so they're obviously using their Visa card to do it. But Ross Stores obviously is a story that has been going. Let's take a look at the moving averages. I bet you it's not that far away from the moving averages here either. And let's just take a quick look down the bottom here. Yeah, 78 to 83. And where are you trading? 88. That's not too bad. You know, that's not really extended. So that one looks interesting to me from the standpoint of your line in the sand. If you were using the 200-day average is only $10 off the current price. If you're using the 50-day average, it's only $5 off the current price. Not too shabby. Okay, and you know, there is a market out there for designer clothes at a discount, that's for sure. Okay, let's look at another one here. I'm trying to get different industry groups so you get an idea that it's really a variety of firms that are doing good. Here's one, Humana, which is in the healthcare area. And let's just see what that's looking like. Symbol is HCA. These are all different industry groups, and that gives you a little idea of you know, the different things that are going on. We're up. We went from $71 this year all the way up to 128, so that's a big mover. 16 is the PE ratio, not too bad. And I would imagine, though, just looking at the graph, that the 200-day average is probably down in the 100 area. So you might be, again, just like the one we mentioned, or O'Reilly. It could be a little bit extended right here. So, and there is a gap at 110 there. I don't know if we'll get down that far, but a pullback is certainly not out of the question. But that's in the health industry there. Here's one for you in the energy industry: Phillips Petroleum, PSX, and that's Phillips 66. And basically, that company just made an all-time high here, and that's 123. Look, it went from 80 to 123. You know, oil snapped back quite a bit this year, so obviously it's benefiting from that. There is a gap there right above 115, and that 115 number would be a kind of a line in the sand for me, as far as I wouldn't want it to get much underneath that, and certainly you'd never want it to get underneath 110. So here you got some support there, and you're in the energy sector, which you know, obviously has been on an upswing. Some people think we could go towards 80 or 90 on crude. If that happened, you would imagine this thing would be participating in that. Conversely, if it goes back to 50, this thing will go in the dumper, but that's not really the probabilities right now, as far as what I can see from the numbers. And that's an energy stock. So let's just see, and I'll give you another transportation one. Okay, this is a Union Pacific Railroad. Okay, these are making all-time highs. Okay, so 151. We went from 100 to 151. That's a 50% jump this year in Union Pacific Railroad. You know, when the consumer is shopping and they need products, and the stores need inventories, they got to get there some way. And Union Pacific is obviously a railroad that is getting products and services to people. So basically, that has a 10 PE ratio. Certainly doesn't look expensive from that aspect. And it also pays a couple of % dividend almost. And that, again, from the moving averages, would probably be fairly close to the moving average. Let's just take a look. So in other words, it's not extreme, and that's not a bad thing. The moving average is at 133 and 140. The 50 and the 200-day, and you're trading 149. So it's a little bit extended. Maybe a pullback towards the 145, 140 area if you could get that lucky. And this thing's going to remain in an uptrend. That would be something to look at. Again, if the month of August will give you a respite from this rally, you know, these are some of the stocks that have been doing quite well. And sometimes people say you buy the dips in a bull market. Okay, that's that's some of the stocks that are, you know, and there are others. If you'd like to know what others there are, at the end of the broadcast, I'll be giving you an email address to contact me. You give me a call. I can give you information if you'd like it. Let's turn towards raising the dividend. You know, people buy stocks because they get a dividend. Why do they like dividends? Because it's like getting paid to own something, right? And if you get paid to own something, if it goes up or down, you're still getting that dividend, right? Now, these companies here raise their dividend by 10% or more. That means if you were getting paid, you know, say you were getting $3,000 a year in dividends from the company because you owned X amount of shares, now you're getting $3,300. So that's and some cases more. I'll show you in a second what I'm talking about. So the dividends are interesting. You know, they're not guaranteed, but these are companies that are growing them. And generally when they're growing them, they obviously have profits and they are returning it to shareholders. Not a bad thing to do sometimes, right? Okay, so let's give you a couple of ideas. One of them is in the advertising marketing business. The symbol is IPG. And that's Interpublic Group. And let's take a look at what they look like here. Okay, their stock this year has gone from 18, now it's at 22. It is increased its dividend by 17% this year. And you can see at 381 is a good, healthy dividend, right? That means you're getting 3.81 yield on the money you put into the stock. Not too shabby. And again, the stock is, down a little bit off its high, 26. But net result for the year has been increase of 12%. So the stock is up 12% for the year. The dividend is just a shade under 4%. And it just increased the dividend by 17%. And, again, if the economy is cooking, you probably have needs for advertising and marketing. And maybe that's why this company is returning capital to the shareholder. Okay, let's turn to another one that increased their dividend. This is an insurance company. And or Lord knows how much we pay in premiums. They should return some of the money, right? This is called Safety Insurance Group. And again, it's up at $91. And it's been as low as 67 this year. And so it has well been rising. It increased its dividend by 14%. 14%. And the dividend's almost 3.5%, not too shabby. And basically, it's a stock that obviously has been going up pretty good. If you bought it a year ago at 67 and it's gone up to 91, the net result in the last year from low to where we are now is a heck of a lot more than 12%. And you're getting paid a good dividend. Again, insurance is their business. Let me give you another one here, which is a pharma. ABBV. That increases dividend by 35%. 35% increase in dividend. It's a pharmaceutical. Now, what's it done? Well, in the last 52 weeks, it's gone from 70 to 125. You know, pharma's always going to be very volatile, up and down. But here you're getting almost 4% dividend according to the screen, and you are looking at a stock trading at 96. And you're getting paid almost 4% to watch the thing go up and down. And this is a sector, healthcare and pharma, that some people think has a fairly bright future. The aging of the baby boomers have a lot of money. You come up with the drugs to help them oversee this, that, or the other. And of course, you can make a buck or two. So, some of the other companies in this sector, like Pfizer, have been doing quite well. So again, it's a sector that is trying to get back in favor, in my view. But at any rate, in here, goes up, goes down, goes sideways, you're still getting a decent yield. And the volume is not too bad, over 1 million shares, 1.5 million shares already traded, and it's only half the day gone. Okay, so that gives you a little bit. There's other ones as well. Again, I'll have an email address for you to contact me if you have any more questions or would like to know any other stocks that are either making all-time highs or raising their dividends like this. Just let me know. I'd be more than happy to give you some information on that. Okay, let's turn towards the sectors here. And I'm going to give you some different information. Now, I'm going to be using the Vanguard sector funds, but and I know there are many ETFs out there. So I'm not recommending any of this stuff to anybody particularly, again, because I don't know the particulars of each and every person who's listening right now, among other things. So let's look at the one for tech. Tech was having a big correction there last week, and then it got back on its bicycle. We saw a little bit of a rollover there on Amazon when it went to 1880, then came back down. Now it's bounced back up. Facebook, way down, bounced back up. And then, of course, Amazon even, Google even came back down, Alphabet, after a big rally. At any rate, here's where you are. The all-time highs, the high on it is 193.50. It's currently at 190, so it's not very far from the high. Right now, you would love to see it take out that 194 high and get moving towards 200. And I would be concerned if it took out that, it looks like what, about 185? And if it took out that 185 and then 180, then that would get me much more concerned about tech. So and of course these are going to have the bigger names. These are all large cap type tech names. Okay, so you're looking at what a rollover underneath 185, a rollover underneath 180 are your caution flags, and again getting above 195 may be the embarkation of another rally. That's what tech on the ETF looks like right now. Okay, next sector is healthcare. Now, people are thinking that this one might start moving a little bit as well. So let's take a look here at healthcare. See, it's been coming up from 155 to 170. And as you can see in the last month, one of the reasons the S&P and the Dow and that have been able to start making it advance is some of these things like healthcare are starting to get on the bicycle. I would think the moving averages on this would probably be in the 160 area. And so any kind of a pullback would be nice. There's a gap that it filled here from February. You see it filled that gap? So next week is going to be very big. If you start rolling over from here, this thing could have a correction. Likewise, if you can really close strongly above 172, then it might be telling us that it's embarking on another leg up. It's really at a crunch point, though, because once you fill that gap, if it can't keep going, sometimes that's the time where it rolls over to the downside. And the volume has not been that great. Look at the bottom of it. So keep an eye on it. Again, it is a sector people like for the second half of the year, but maybe it has gotten a little ahead of itself, and maybe it'll give you a dip in the month of August. Only time will tell. Okay, next one is going to be in the financials. Everybody's been touting the financials since January, and the financials have not exactly delivered the goods, but they have started to turn up a little bit. You see how everybody plowed into them, and the ETF went to 76. You know, here's your banks, insurance companies, that kind of thing, right? Way up to 76, then bam, right down to 68. The whole world got long in January, and they've been struggling to see water. They've been underwater trying to get back to fresh air. And it tried to get up to 72. Seems like there's resistance at 72, and there's that gap over there on 72. So I think if we can start closing above 72, that would be very constructive for this. And clearly above 75, which is the high, would be very, very constructive. Up until that point, you know, there really has not been any proof that it can get above 72 and 75. So keep an eye on it. And they say higher interest rates are supposed to be helpful to the banks. So far, that has not exactly been the case. Okay, next sector to keep an eye on after financials is going to be the industrials. This one is sneaking back up as well. And by the way, the moving averages on the financials and the industrials are not very far from the price, so that's not a bad thing. Again, running into that resistance at 145, right? Bam, bam, bam. And basically, if we can get above 145 and start closing, that would be very much a confidence builder to me. And then, of course, above 151, you're into new highs. But again, we'll have to see what the next couple of weeks bring, because right now it is in a situation where it's having resistance at 145. But they do tell me that, you know, the Boeings and the other industrials, you know, if we have a big second half, are supposed to participate. Right now, it's all that's done is come up against resistance. So you got to be careful at this point. Next sector is going to be international, another one that was touted in January. And there you go. This emerging market. Look at it in January. Everyone's jumping in. Financials, Europe, you know, emerging markets in January. What have you done since then? You've been losing money, and you're dying to get back to 52, and it ain't near 52. It's at 44. It's definitely still in a downtrend, and again, it looks like it's going to have some trouble getting above 46. If it can get above 46, then I would have more interest in this, because again, you know, unless you're day trading or doing something short-term specking, you know, if you get into something, you'd like to have a little bit of growth potential, and until it gets above 46, where all those lows were, and it might be difficult to get much growth out of it. But again, above 46, it would tell me that it could be getting back on the bicycle. And then, of course, you'd use 42 and this 44 area as your lines in the sand if you could get this thing above 46. Again, emerging markets are really the area where the tariffs are going into, that Asia area. And then, of course, some of the other emerging markets like Brazil might benefit, might be a decent area to be in if the commodity inflation comes back, or if they keep buying soybeans from Brazil rather than the U.S. Turning to the Last one I've got, on the internet, excuse me, on the international Europe. People are talking about Europe. They just raised rates in England. Again, everybody got in January, and they haven't seen daylight since. This thing's still in a downtrend. You'd like it to get above that 40, 41 area, and then if it does that, use your 39 area as a line in the sand, and then 38 underneath that. But again, Europe is still downtrending, and has been a very bad investment all year long. Last one here is going to be on materials. Now, this one I'm trying to keep an eye on because, if there's going to be inflation because of the tariffs, maybe the materials will go up in price and their margins will go up in price. Again, like many of the sectors, they've gone up, but they need to get above resistance to really get interesting. Right now, we'd love it to get above that 136 area and then use that 130 area as your line in the sand, and then get above 140, and then you're really going to be going somewhere. Right now, again, up towards resistance, rolling over a bit, filling a gap today. But if next week this thing rolls over, that means it might be too early to be in the into the material sector. Okay, I've just got a couple of minutes here, so I am going to go over just a couple of other things. And again, then I'll give you my contact email. There may be questions that I've generated out of this talk, and I certainly would like to help you if I could. Interest rates. Let's take a look at the 10-year note. It jammed up from 280 all the way back above 3, and now it's been backing off a little bit. That unemployment report today probably got people thinking that things are not as hot as they seem. So you see we went from 280 back to 3% on the 10-year, and now it's back to 295. Again, 157,000 jobs when they're looking for 193 or 213 is obviously a disappoint. So that takes a little bit of the bloom off the rose on this fast-growing situation that people were getting a little bit ahead of themselves on. So right now, that 3% seems to be resistance. If you start getting above 310, then this thing is really probably going to go. And if it can't, it could meander between 280 and 3% for a while. And that's basically what's going on. They are looking for a hike in September out of the Fed, but that's pretty much widely known. It would actually be quite shocking if they didn't do it. With regards to the US dollar, that has been strong. I have been suspicious of it because, big deficits down the road doesn't sound to me like something you'd be bullish on. I mean, if other countries were going to be running huge deficits because of tax cuts and stimulus packages, you'd probably be nervous about their currency, not excited about it. So you can see the US dollar is up there in the 95, 96 area. I am suspicious that that is resistance that would be difficult to take out. If it gets above under 94 on the dollar index, I think that because it's been going sideways so long, it could have a drop down towards 91. So I would be very much watching this thing here. And again, if it gets to 96 or better, then the dollar could go who knows where, maybe to 100 or higher. And if it gets under 94, then I think the dollar could go into a correction. And maybe that euro, which has been holding 115, could turn up from there. We'll have to keep an eye on it. I had thought that was going to happen, but as of right now, it's just basically going flat. All right, let's turn to a couple of other markets that you might be interested in. In the oil sector, let's look at the ETF. Oil prices have been kind of steady. Look, similar to the dollar, right? It's been in a trading range. You get above 78, that would be very positive. If you start breaking under 74 here, then again, a correction could be in the cards. And it does look very much similar to the dollar graph. Gold has been hit and hit hard, and basically so has silver. So you have to wonder either A, are they near their lows, or is there, if there's going to be no inflation and the dollar's going to get a lot stronger and the Dow's going to take off again, it's kind of tough. But there is a little bit of a tail on gold right down there at 114. And if it starts turning up, there's a gap right there under 117, and there's resistance at 122. So if it can get turning around, that's where it would try to go, but that is a downtrend by any measure. And one stock that I've kept an eye on here is is Barrick Mines. And Barrick, all the gold shares seem to be very much on their lows as well. Barrick hit 1085. It's turning up a little bit, but look at the high, 18. And now it went down to 11. That 11 was a number, or 10, right? That seems to be a former low down there as well. So keep an eye on the gold, when things are this far out of favor, and there could be inflation coming, and there could be big deficits coming, and higher interest rates coming. And if the dollar is going to be volatile, sometimes these things that are way out of favor, like silver at 15 bucks an ounce or gold at around 1200, could have some value. And some of the stocks clearly are on their lows here. So, although you're buying into some downtrends, you're also buying a heavily discounted price on the stock. Okay. All right. We are out of time here today. I want to thank everybody. Oh, one last thing I did want to show you is in the agricultural sector. Just 1 second here, and then I'll wrap it up. The reason agriculture is interesting to me is because the tariffs are heavily involved with the farmer, right? And because of that, they came up with a bailout package of $12 billion, which is positive. And also, if we get any kind of a agreement, it could be very helpful to soybeans. And you can see the price has gone from 10.75 in the last year all the way down to 8.25. That's near a 10-year low. And look at the volume screaming. So a lot of people are dumping, and sometimes when you see high volume, sometimes that is a turning point. So using 8.25, if you get pullbacks on it and it can hold 8.25, it might be interesting. And then ultimately you'd be looking for the 9.75, $10 area if it can make a turn. Again, the subsidy may help. In addition to that, if they get the tariff thing squared away, because Europe is supposed to buy more grain from us, but they are only 1/10 the size of China. And supposedly if we can get something cleared with China and they started buying soybeans, that'd probably be very constructive for this market. So keep an eye on it and see what happens. Okay, again, this is it for this week, August the 3rd, 2018. I'm Jim Kenney, and I am inviting you to contact me at OptionProfessor@gmail.com. That's OptionProfessor@gmail.com. You have questions, you have comments, you need any, you would like to talk to me about things you've got now or things you're thinking about, more than happy to give you a hand. Until next week, I wish all of you the best and good trading. And until then, I'm Jim Kenney, and I'll talk to you next week.